Have you ever wanted to give gifts to your loved ones, but don't know where to begin? Whether it's a college fund for a grandchild or help with a down payment for your children, we'll guide you through the do's and don'ts of giving to family and friends. So tune in and we'll share about how to give gifts that keep on giving without derailing your own financial goals.
Today we're excited to talk about 5 logistical elements that we think you should know about gifting to loved ones, and then also some of the practices to focus on and avoid to make those gifts all that more enjoyable and redemptive, really, as you make them, practically speaking. So as we think about the 5 things to know logistically about tax implications, the first one that we always get is, well, how much can I gift to them without there being any tax? So Austin, you want to walk us through what the annual gift tax exclusion looks like, and then also how that relates to the overall estate tax exemption.
Yeah, so we've said this before. If you give a gift to a loved one, cash to a family member, there is no tax benefit. You do not get a tax write-off. You do not get a tax deduction, none of that. So we want to say that first and foremost. But in 2024, as we record this, the annual gift tax exclusion is $18,000. So that means if you want to give any individual, this doesn't have to be children, it can be a friend. If you want to give a gift to someone less than $18,000, the IRS has said, we don't need to know about it. So if you want to give more than that though, that's where you really have to fill out a gift tax form with the IRS. And all they're doing is they're taking an account of how much you have given to an individual up over and above that exemption amount. Now, the estate tax exemption currently sits at about $13.5 million. I believe it's $13.6 million per individual. And so until you reach $13.6 million of gifts, you're not going to have estate tax due on those gifts that you give. The IRS just wants to know, okay, where are we in that accounting of it? But if you have a husband and wife, you can combine your gift exemption and give up to $36,000 to any one individual. But again, you just have to make sure that you're under that threshold. And when you go above that threshold, the IRS just wants to know.
And if you're above $18,000 giving to one person as a couple, you do have to file a split gift return. There is just a little bit that you'd work with your CPA on that. But again, there's not tax due. There, which is one of those things that's always a question. Am I getting a tax benefit in a deducting, or am I having to pay tax? And the answer for both is no.
Right.
So the second thing there, that lifetime gift tax exemption, can you unpack how that works together again when we think about annual gifts and when we think about charitable, or when we think about bequests at the end of life? How does the government factor all this in together?
So Spencer, the lifetime gift tax exemption is essentially you've got $13.6 million per individual, that if you don't exceed gifts above that amount, there's going to be no estate tax due on those gifts. The IRS just wants to be able to keep track of record. You want to touch on portability just a little bit?
Well, and so it's 13.6 million, and it's that unification of lifetime gifts and end-of-life gifts there. So we've got those two pieces, but then, like you said, there is portability. So for spouses, you've got basically double that amount. And provided that you pass resources on to a surviving spouse, there's not going to be estate tax due on that transfer of resources, and then you're going to have double essentially. So right now you've got a little over $27 million for a couple, again about $13.5 million for an individual. Those amounts are set to drop, be cut in half in 2026 when the Tax Cuts and Jobs Act would sunset, but still a really, really high level for most folks, $6.5 million for an individual, $13 million for a couple in essence, even with that sunsetting. So we've talked about, again, annual gift tax exclusion, the lifetime gift tax exemption. That third piece that we want to talk about, the tax consequences for the recipient. This is a question that we get so often. What are the tax consequences for the recipient?
Well, they don't really exist. So if you receive a gift from a loved one, the tax implications are always going to be on the donor. So really, there's not any tax implications. Now, if you receive an inheritance, let's say of $40 million, there is going to be a estate tax due that's going to cut into that. But that doesn't come out of your pocket. It comes out of the estate. And so really for the recipient, you don't have to pay the IRS directly at all for gifts that you receive.
And the one caveat there would be, of course, if you receive, say, appreciated securities and it's during the giver's lifetime, then the cost basis does come over.
Right.
So you would have long-term capital gains and tax due on that if you should sell it and it applies in your particular circumstance. That's rather unusual, but it can happen.
Yeah.
That's the only way that you would really have any taxes if you received it and then sold it and then used those proceeds, right?
So we talked about the annual gift exclusion. We've talked about the estate tax exclusion. We've talked about the tax consequences for that recipient. The next piece we want to touch on is just keeping good records. So we mentioned this with, if you want to give above that estate, the annual tax exclusion, you just have to let the IRS know what are some other records that really need to be kept in terms of the gifts that you make to loved ones.
Well, if you give appreciated securities, you want to make sure that the cost basis transfers over there. You know, if you have highly appreciated securities and you pass those on to grandkids, for instance, you want to make sure that they've got a paper trail of what the cost basis actually is there. And just generally speaking, you want to have your house in order as you make these kinds of large gifts if you should want to do so.
Mm-hmm. Okay, so the last one is considering alternatives to cash gifts. Mm-hmm. So talk us through, you've mentioned giving stocks, bonds, appreciated securities. Talk us through contributing to a 529 plan for grandchildren.
Well, there's different ways that you can make gifts to people or for people that can be more tax efficient than others. Now, 529 plans are one of those ways that if you make a gift to a 529 plan for a grandchild or child or some loved one, those resources go into an account and hopefully they grow over time. Now, ordinarily, if you just kept those resources in your care or you had given those resources and they were set up in a non-qualified account, there would be some tax typically that would be due on the gain of that investment or on the interest that would be paid out from that investment. If you put it into a 529 plan, you don't have that taxation on the growth of those resources, provided that you use those resources for qualified educational expenses. So there are ways like making those gifts to, say, 529 plans. Another thing that you could consider would be if you're making gifts to someone who has a lower tax bracket and you're giving them appreciated securities. Now, you know, if you're in your 90s and you think, well, I may only have a few more years to live and you have highly appreciated securities, typically you want to keep those, not gift those during your lifetime, but keep those because under current tax law, there is a step up in cost basis at your passing. So you pass those resources on to your loved ones and there's no tax that's due to them when they make the sale of those securities typically, or it's a very minimal amount compared to the gain oftentimes. But let's just say that you're a grandparent and you're in very good health and your life expectancy might be 20 years and you want to pass on resources to a grandchild who might be just graduating from college. And they're at a very low tax bracket, you know, obviously, because they have a very low level of income. You might be able to pass on, you know, $100,000 in highly appreciated stock that they would pay little or no tax on, that you might have been paying significant tax on if you harvested those gains. Particularly, we've seen this used in circumstances where a grandchild might be looking at graduate school or might have significant expenses from purchasing, having a down payment needed for a first home or something like that, where a grandparent really wants to get behind one of the financial goals of the grandchild and thinks that they'll use those resources well. Doing a gift of highly appreciated securities sometimes can make a whole lot of sense.
Right. And we want to say here too, with the alternative approaches, there are a couple ways that you can get around that annual exclusion. Mm-hmm. If you are paying the direct medical bills of somebody else, if you're paying them directly to the hospital, so not giving cash to the beneficiary and the beneficiary paying it, then there is not a limit. Mm-hmm. So let's say you have a friend that has $50,000 of medical bills. If you pay the hospital directly for those bills, that's outside of the exclusion. Similarly with paying college tuition, if you don't want to fund a 529 account or try to go through the hoops to get cash to the beneficiary, those annual exclusions are lifted, but you have to pay the institution directly. You can't go to the beneficiary and then the beneficiary pay. So we just want to make sure that you understand when you're making gifts, if you want to pay for college, if you want to pay for health expenses, you can do it over and above those annual limits. Just make sure that you're giving directly to the institution. You're paying that bill directly, rather than giving the beneficiary. And run all of those things by your tax professional. Really, that's what we want to come back to here is you really need to consult a CPA with any of these strategies that you take to make sure that you're not running afoul of the IRS. All right, so Spencer, one of the questions that we get most frequently is how do I give gifts to loved ones? Our clients love to be generous. They love to give gifts to charity. They love to give gifts to family. But they don't want to run afoul of either the relationship or the IRS when they do it. So we want to start off with 5 practices that will help clients continue to give with joy to ones they love. So talk us through this first one. Set clear goals for gifting in the context of a long-term financial plan.
Austin, this really comes back to the approach that we take with financial planning. We want to start with life planning. We want to understand what's the money there for? What are the goals that we have with these resources? Then as we look at the financial plan, that is the cash flow and how we use resources, then it's a lot easier to get a clear picture of what's possible and when we want to do that. And then after that, we can start layering on how do we do that? How do we surface these conversations? How do we get into these next steps? But it all needs to start with what are our priorities, those core values that we have on a life planning side, so that and then we can use as stewards these resources well.
Yeah. So that really comes in context then with this next one, the next practice, understanding the financial needs of the recipient. So we don't want to just give gifts to people that don't need it or that it's going to maybe increase their lifestyle exponentially to a place where maybe we don't want to increase their lifestyle. So walk us through why is this so important to understand the needs of the recipient?
Well, we want to be wise stewards of these resources. There are ways that people can receive resources or they can gain resources that are actually detrimental to their personhood. Yeah. We see this in winning a lottery, as an example. Now, obviously, winning a lottery is far different than receiving a gift from family, but the receipt of those resources can do violence to an individual. And so we need to have a sense of how might these resources be used, what would be the way that a recipient might approach. So for something like a down payment on a first home or helping out with childcare, when they're young and you have grandkids and they need some extra resources to be able to help keep the family at a good spot. There's different ways that they might use resources that are tremendous and very, very helpful. And then there's others that, if you know that the person's just going to take it and use those resources on some kind of a wild trip that might be detrimental to themselves, it might not be something that you want to fund.
Right. Okay, so that really dovetails well into this next practice. We want to be really intentional. We want to have good communication with our kids, with our spouses, as we're talking about how to give gifts to kids and grandkids. If you want to watch our video, our interview with Adam and Dana, we talk a little bit about the importance of communication and intentionality. But why is this so crucial?
Well, everybody just needs to be on the same page. You're making a gift and you may want to specify, I'm really hoping that you'll use these resources for additional help with childcare or for a down payment on a home or whatever it might be. But you want to express the love and the care that you have for the person, but also you may want to express how you're hoping those resources will be used when they're received. In essence, we want to have initial conversation and then we want to have follow-up just to make sure that we're all on the same page. We want to do that with a level of intention.
Okay, so that really, again, we're kind of building these steps. So the next one is laying out specifics. So this is the frequency of the amount, the communication that you have over time. Is it just going to be a one-time? Is it going to be annually? How do you want the resources to be used? Talk us a little bit more through those specifics that really need to be communicated up front.
Well, what we want to do is we want to make sure that there is a level of communication, that everybody's on the same page, and the specifics such that if a gift is given, and let's just say you're going to give $50,000 to a son or daughter to help them with a down payment on a home, as an example, they need to understand, okay, is that a one-time gift or are there any other elements coming thereafter? You would be surprised at the number of times that we see families, an initial gift like this is made and there's a level of expectation that there's more coming in the near future, and mom and dad never said that, never intended to convey that. And so being able to be very specific to say, hey, we don't have resources that we plan to be passing on every year. We're going to make a stretch here, and in this year, we really want to be able to help you with the down payment on this home that you're considering. We want to pass on these resources, and we're going to do so at this time. So getting into those specifics, the amount, the time frame, and then what the future thought is, are really, really helpful to protect the relationship. Because sometimes children or grandchildren might think that, again, there might be more on the way, or may not be clear about when that timing is going to be, or even what it's for. They might think, okay, well, this is just for anything that I might need, rather than, no, I'm wanting to make this gift specifically for the purchase of a home.
Right. Well, and I think this is really important too, as we talk with clients about accelerating their giving during their lifetime so that they can really see how the beneficiary uses the resources. It really becomes crucial then to say, hey, you may not get as much when I die because I want to give you more during my lifetime.
Right.
It becomes really crucial to have those conversations, because if a beneficiary is expecting a very large inheritance, but the benefactor has been accelerating the gift during their lifetime, there could be animosity. And so we just want to make sure that we are heading that off, being really intentional, really forthright with those conversations during lifetime.
Well, and that also can be something that if it's year-to-year gift, we really want to make sure that, again, the amount, the specifics are put together. So if it was for $10,000 a year or $20,000 a year, say for a child's education, then as one who is making a gift, you want to make sure that the recipient knows that there's an end time frame for that. It could be that you're helping out with childcare that is preschool. And so your thought process is, well, I'm helping out with $6,000 on an annual basis, and that's going to end in 5 years. Well, the recipient needs to understand that there's a time frame there that's going to end, because he or she could build that into the budget and then think, okay, well, we'll have a little bit more space when Johnny is off to kindergarten, because we'll continue to receive these funds, but that wasn't your intention. Right. So getting on that same page can, again, help protect the relationship there too.
Yeah. So let's talk about this last one, boundaries, emotionally staying on your side of the fence when conflict arises. So talk us through this one a little bit.
Well, even in the best laid plans, even in families that have tremendous communication, or mom and dad that have tremendous communication, sometimes there is a level of either misunderstanding or grandchildren that don't understand how to use money. They don't have that same level of discipline yet that mom and dad do. And so we have to make sure that as we make those gifts, that we stay on our side of the fence. Particularly if we've done all these different things, we understand where they are in the context of our own financial plan. We know that it is a core value to pass these resources on. We're willing to take that risk of passing them on, of having that conversation with child, grandchild, as it needs to be. We're intentional about communications both before and then following up. And one of the things that oftentimes we would encourage is just checking for understanding of you telling a beneficiary, okay, here's what I intend to do, here's the time frame, and having them be able to come back and speak that so that you know that you're on the same page, then following up with written communication about that, laying out those specifics. But even if you do all of that perfectly well, sometimes it doesn't work.
Yep.
Sometimes there's this level of intensity of like, well, I have the same need, and it's the same intensity as I had last year. It's just for a different reason, but it might be for a reason that you say, I'm not going to help you out of that one. You might be helping, again, for instance, a grandchild with education, and that need has moved on, but it is a son or daughter then that has mismanaged some funds or something else happening. And they're saying, well, I still need that same level of help. And you're saying, no. You have to be comfortable saying, okay, that's just not going to be the right fit, staying on your side of the fence emotionally and just letting the chips fall where they may. Now, again, we can protect those relationships and do a good job for those first 4 points, but we have to still be comfortable with the fact that when we talk with others about money, when we make gifts, it does expose us a little bit to some of these conversations and situations that are outside of our control. So we want to stay on our side of the emotional fence when things get more dicey. And a lot of times they won't. Yeah. There's a lot of families that we see, they never get dicey, but there's some that will. And so we just have to be comfortable that we are putting our core values in place. We're doing everything that we can to help our loved ones. And sometimes that just means that we have to draw that line and not go across it emotionally.
Yeah. Well, thanks for setting up those building blocks. So this next part, we're going to talk through 5 mistakes to avoid. So the first one, we want to avoid impulse giving or responding immediately to every request. Talk us through this one a little bit.
Well, it's great, even if the need is important and it's pressing, to just pause and not make a statement or not make a promise immediately when the request is made. So we want to have enough space, even if it's just a couple of hours, to be able to step back and say, okay, I hear you. I understand that these are the reasons, and I will take those into account and get back with you in a prompt way. And that might be weeks, it could be months, it could be hours, but you don't want to feel like you are pushed on that moment to say yes. Because sometimes even then, if you say yes immediately, then the request that you thought you heard expands. So what you want to do is you want to say, okay, help me understand exactly what you're looking for here, get the specifics, then take some space, again, even if it's a couple of hours, and come back, and then you be able to say, this is what I'm willing to do, this is what I'm hoping to do, this is the intention, the time frame, the specifics, and that can kind of set those expectations in a much more healthy way.
Yeah, that's good. Okay, so the second one there, avoid over-gifting. What is this?
Well, there's just a lot of folks that say, well, I love my kids, I love my grandkids, I have all these resources, why would I just not pass them on earlier or at some kind of sequence? And what we again come back to is this can cause harm to them if they're not ready for them. We see this on too frequent a basis, that either a grandchild or a child will receive gifts that they're going to be harmful to that person. And so it's very, very sad when people are living in a particular way where the receipt of extra funds is going to create violence to their soul, to their person. But that can happen. And so we have to make sure that we are not adding gasoline, to that fire there. We want to make sure that we're actually helping in terms of giving. And usually that means that gifts can be made on some level, but we need to make sure that we're not creating dependency, that we're not creating a circumstance where the expectation is that mom and dad are always going to be there to also bail somebody out.
Right. Okay. So let's talk about this next one, not running from emotions. It kind of builds back into that, having boundaries and setting up intentional conversation. But why should we not run from our emotions?
Well, money is emotional. We come back to that oftentimes. Money is emotional. And so if we make any kind of gift, there's going to be some emotions that are tied up in that. They may be exclusively positive, really, for the recipient and for the giver. It could be perfect. But we also have to recognize that there could be negative elements of that. There could be misunderstandings. And sometimes money can increase the intensity of those. The thing that we have to get comfortable with, though, particularly with not running from emotions, is resources are going to go to people or institutions over time at some point. So we have the opportunity to grow into having those conversations, as imperfect as they may be at some times, but to go ahead and address that during our lifetime, particularly to be able to have an impact on people and causes that we love through the years, and not just wait 10, 15, 20, 30 years down the road to be able to pass on some of those resources.
Yeah, that's good. So we've talked about this one a bit, but this next piece, don't fail to maintain consistency of communication. Anything else you want to touch on that one?
Well, I think we just want to be very proactive, and we just, at least on an annual basis as gifts are made, we just want to come back and remind everyone, what the intention is, what the goals are, and it's hard to over-communicate. I think that's one of the things that people don't appreciate with money sometimes is it's hard to over-communicate. Much like, if you're playing a sport, I would far rather have our team communicating really well on the defensive end of a basketball court. And if your teammate knows exactly where you're at, you reminding them, hey, I have help defense right over here, it's not going to harm, usually. Instead, it's just going to, again, reinforce this is the plan, this is the approach. And if it's done, on an annual basis or a couple times a year, that shouldn't be perceived as any kind of threat from a recipient.
Right. Okay, so this last mistake to avoid, using money to compel behavior. I think this is fairly straightforward, but talk us through why this is really important to avoid.
Well, we want to avoid making resources with a lot of strings attached. Now, we can tell people, hey, I'm really excited about the potential that you're going to buy this home, and I want to get behind something that you're already up to. Or, hey, I'm so excited that, we have these grandkids and we want to be able to help, support them, in their education or whatever it might be. We want to be able to get behind where people are already moving. However, where we see this go afoul sometimes is when you have a desire and it's not the same desire of the recipient, and you're trying to compel or push them in a particular direction. For instance, saying, well, I'll give you $100,000 if you get a college degree or something like that. Well, is that really going to help the recipient? I mean, they might spend 4 years, really pursuing that college degree in something that they're not passionate about just so they can get some money. We look at the strings attached gifts as oftentimes not enhancing a relationship, and oftentimes not enhancing the recipient, not actually pushing them in the direction that you would like them to go. It's more of the relational capital that you can build over time as you invest in a relationship, hopefully that you can then have an influence rather than trying to compel that or try to have that influence just with pushing on resources. Well, we hope that you found value in what we've shared today, both on the logistical side and then also some of the relational, experiential side of things. If you have any questions, don't hesitate to reach out to us. We'd love to interact with you on this. And until next time, take care.
If you like these financial planning videos, please share it with a friend. And if you have questions, go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.